Now, our main focus point is about how high income earners are starting to struggle. We've talked about this for a while, that we were kind of in this K-shaped economy. If you're owners of assets, especially if you had a home and locked in a 3% mortgage, you were in pretty good shape for the most part. Your housing costs didn't really go up. Maybe your insurance did. But besides that, the bulk of your cost of housing was static. But if you were a renter, you were feeling higher rent costs, higher utilities, etc. And maybe you were getting raises, but they were kind of barely keeping up. But once again, if you owned a home, that mortgage was flat and you are also probably getting a raise. And so those higher income earners were typically the ones that were homeowners. And so the renters, lower income people were struggling more than average. Now you're starting to see this creep into the higher earners. These are people making over $150,000 per year. Now, the delinquency rate for high earners is up 130% over the last 2 years, from January 2023 to December of last year. Now, this is the type of stat, though, and I'm saying this stat because I see this all the time. Oh, it's up this huge number. Well, what is that first number? Is that first number very low? Is it average? Is it high? Well, the reality is it's very low because consumer balance sheets are very strong generally. And so while, yes, delinquencies are up, it's from a very low base. So it's not something to panic about. But what you can see is that home insurance costs, auto insurance, just inflation in general are starting to drive delinquency rates up across the board. Now, credit card balances were up 2.9% year over year as of the end of last year. But that's kind of in line with inflation, so that's not really a worry. And overall credit utilization is actually down 1 full percentage point. And in December, and that was the second lowest mark in 2024. So yes, delinquencies are up, but in general, there's a lot of untapped credit that higher income earners can utilize. Now, there are some potential issues on the horizon. Number one is if you haven't caught up with your student loans, that's going to be now reported as delinquent and could hit your credit score by as much as 80 points and could make that credit utilization or credit availability, go down for people, whether you're making $200,000 a year or $50,000 a year. Now, then you go and look at what is called the Bain Consumer Health Index. And it looks at only high income earners. And they showed a 10.8% drop in intent to spend. So yeah, they can go spend, but you're starting to see many of them see some uncertainty around, what's happening with the tax rates, with the tariffs, and just generally with the stock market, which, are gains going to slow down? I think that's apparently some of their worries. Overall, though, this is not something that you want to get too up in arms about. Yes, it's important. And the high income earners are roughly 2/3 of consumer spending. So their propensity to spend is vital to the overall economy and overall growth. However, there's still a lot of capacity to spend. And the main source of that capacity is equity in their homes, right? There's nothing that says that in the near term, housing prices are going to drop dramatically. And therefore, so many people are paying down their mortgage at 3%, right? They might be getting a raise, so they've probably been paying into their mortgage a little bit more as well, paying down that faster. Delinquencies on mortgages are still very, very low. And they can go and tap credit when they need to. And so while delinquencies are rising, yes, it's from a very, very low level. So don't get too up in arms when you see these headlines about delinquencies, whether that's on housing, whether that's on credit cards or whatever it is. There are pockets of weakness, but frankly, there are always pockets of weakness. But generally, while the wealthy consumer looks to be slowing a bit, it's not anything that's going to precipitate a recession.